Excellent. Good morning, everyone. Thank you for joining us today. We'd like to welcome you to the second day of our ESG conversation, talking about the convergence of E and C with ESG. Good morning. We'd also like to thank our sponsors, the Center for Audit Quality, CAQ, presenting today, Con Resnick, Ethico, OneTrust, and Vault Platform. Before we get started, we do have a couple of housekeeping items. So if you could please be sure to keep your mics muted while the presenters are presenting, we would really appreciate that so we can all hear everything that they want to say. And then please make sure that you use the chat function to submit any questions that you have during the presentation. That's my dog. I'm sorry about that. And in the first session, we're going to be talking about maintaining professional skepticism in ESG reporting and assurance with CAQ. I'm going to pass the microphone over to Margot, and she's going to introduce the panel. Thank you, everyone, for being here this morning.
Thanks, Nadine. So, as you all know, you can't pick up the Wall Street Journal, a Financial Times, an Economist, or any other highly regarded print media without seeing some article on ESG issues, including the types of information that companies are disclosing, whether it's in their SEC filings, in separate sustainability reports, or even on their websites. The compliance function, as you know, plays a critical role in company disclosures, and so it's important that you all keep abreast of what's required, what investors are asking for, as well as the accuracy and the reliability of the information that your company is providing. Today, we're going to provide an overview of the SEC's proposed climate disclosure rules. We're going to look at the state of play in disclosures around ESG metrics, with a particular focus on climate-related disclosures, and we're going to discuss some of the key risk areas that compliance teams should be aware of. My two panelists, Chris McClure from Crowe and Joey Bailey, my colleague at the CAQ, will be covering these issues and others. We're going to be leaving time for questions at the end, so please put them in the chat. We'll get to as many as we can, and we'll be at the Q&A wrap-up session this afternoon. Before I have Chris and Joey introduce themselves, I think we want to start with the first poll, which is, how familiar are you with the SEC proposed climate disclosure rules? Are you very familiar, somewhat familiar, not very, or not familiar at all? So, Chris, why don't we go ahead and why don't you introduce yourself?
Yeah, good morning. Thank you, Margot. It's a pleasure to be here. I'm Chris McClure, partner from Crowe, and I lead our National ESG Center of Excellence. So that's a cross-functional team we have at Crowe that works with clients and prospects across all different industries to help them understand ESG, what it means to them, trends, regulatory obligations, customer requests, all the things that we're seeing around ESG. So it's really a pleasure to be here with you today, and I look forward to sharing some more specifics with the audience.
Great. And Joey?
Thanks, Margot. And it is great to join you as well, Chris, this morning, and thanks to everyone for joining us. My name is Joey Bailey. I'm a manager on the professional practice team at the Center for Audit Quality. I help a lot of our ESG analysis, analyzing a lot of corporate reporting, 10K, sustainability reports. I've been a CPA for around 10 years working for public and private companies, and have spent a number of years specifically focusing on environmental, social, and governance reporting. So I'm really excited to join Chris with Crowe and Margot and the ECI team today to give you some insights into what we've seen, and hopefully provide you with some practical takeaways and some information that you could walk away with. So thanks for having me.
Okay, so looking at our poll results, Chris, it looks like 48% of our audience isn't really all that familiar with the SEC rules. So those rules. So I'm going to share my screen and we can get started here. So, can you provide us an overview of the current reporting requirements on climate-related disclosures, and what are the key aspects of the rule? Sorry.
Sure. So the regulatory obligations on the whole are an important part of ESG considerations, and they really form one of the key foundations that all of our clients need to assess as they're looking at ESG overall. So today we'll talk specifically about the SEC's role in ESG, and there's been some important developments here in a rather short time frame around how the SEC views ESG related reporting. So when I talk about ESG reporting, it could be information that's in your financial statements, and we'll talk about the SEC rule that will potentially require you to embed more ESG information into your financial statements, and then also talking about other ESG reporting. So a lot of you may have on your website with your company a sustainability report or an ESG report, separate and apart from your financial reporting. And those sustainability or corporate responsibility reports could be, 5 pages, 25, 100 pages. And traditionally, those reports were prepared by maybe your investor relations team, marketing team, with help from whoever focuses on sustainability to your organization. But again, very separate and apart from your financial statement disclosures. Well, the SEC's perspective on this is very unique now. And what they say is that ESG information, so anything that you're producing, information about how you deal with climate and how you protect the environment, how you protect your employees and the benefits you provide them, your diversity, equity, inclusion programs, anything you're doing from a governance perspective, all those types of disclosures are very important because investors are really focused on those metrics. And from the SEC's perspective, those types of that type of reporting rises to the level of an investor disclosure. So that's a really, really important concept to start with here. That the SEC no longer really believes in a voluntary and selective narrative reporting. What they're pushing for now is data-driven, consistent, and audited reporting around ESG topics. So if you think of the world that we're in and where we need to go based on what the SEC is saying, we've got a long way to go in terms of getting everybody there. And as we referenced there on the slide, the SEC has a climate and ESG task force that they established earlier this year, and they're already off and running with a number of enforcement actions across a variety of different industries. Investment advisors, there's a mining company, there's an electric car company in there. And one of the key things about these enforcement proceedings is that regardless of the industry and when the events happened, the SEC is explicit in the enforcement proceeding to point out that the organization that's subject to the enforcement action had misleading ESG disclosures on their website, whether they're safety issues or information about green investments. So it's a very, very broad concept. So we want to set the stage about what the SEC is looking for, first and foremost around ESG reporting. And now let's dive into the SEC climate rule. So, Margo, if you can go one slide back and we'll start there. Earlier this year, the SEC produced a proposed rule in March, which for the first time introduced the concept of climate risk reporting in financial statements. So the rule was proposed in March. We had a comment period that went for a couple of months, was extended, and was just recently extended again to the beginning of November. Many, many comments came in, over 14,000 comment letters. Very, I would say, controversial rule. There's a lot of information here, a lot of requirements. So what I'll set out for you today is just at a high level what the proposal is for this rule. And the goal of it is for publicly traded organizations to address in a comprehensive way their exposure to climate risk and how they are addressing it. And so it focuses on, and you can go to the next slide. It focuses on really a high level narrative to start it. The alignment here is with what's called TCFD, which is a framework that's been in place for a few years, a voluntary framework. And this SEC rule points to that framework as a guideline for how you can craft your initial disclosure. And it starts at a high level with narratives around how your board and management are assessing and managing climate risk at your organization. So what's the governance structure and how does management look at these issues? How do you consider the impact of physical climate risk and risks as the economy switches more towards renewable fuels, risks and opportunities that your business may face? And then it gets into a quantitative measures, so an actual greenhouse gas emissions inventory. And this is the point I think where everybody's really focused on is how do we do this? How do we measure our emissions? What does that mean to us? It looks very different if you're a large manufacturer versus a bank versus a professional services company, but everyone that's a public filer would be subject to these disclosure requirements. And then there's some scenario analysis around, how did you assess exactly how climate would impact you, and other disclosures that are kind of embedded in this overall proposal. There's a lot in this proposal. There's a lot of major issues around materiality and which types of emissions are included, and a lot of different subjects that have been the focus of all those comment letters, 14,000 plus comment letters. The latest update is that the SEC is evaluating those letters. We thought there'd be a final rule really by October, was where they had initially committed, but it looks more like it'll be the end of this year or maybe into the first quarter of next year. So we can go forward. So I just want to touch on, I talked about greenhouse gas emissions, and I just want to set some baseline definitions for you so that we understand as we're talking through these things. Scope 1, 2, and 3 emissions is what you'll hear a lot about. And at a high level, Scope 1 and Scope 2 emissions are really the emissions that you control. So those are emissions that you own, either boilers or furnaces and manufacturing processes within your owned and leased facilities. And Scope 2 is really the utilities that you purchase. So that's information that you can capture. A lot of it you might already have, or you can get more quickly and directly from your utility providers, landlords, and others that you do business with. Scope 3 is the concept that I think causes a lot more discussion, because that looks at the theory around your entire value chain. So everyone that you do business with in the life cycle of your services or your products. So that would be, for example, reaching out and capturing emissions information from companies that you use to transport goods that you sell, concepts like that. So that would require you to reach out, connect with these businesses, and ask for information about their emissions and include that in your calculation. So that recognizes the interconnectedness of everybody with their suppliers and vendors, creates a lot of concerns about whether you can just use proxy information or whether you have to request that information from those suppliers. A lot of those suppliers and vendors are not public companies. So some of these private providers may be scoped in. We're already seeing a lot of our clients being asked for Scope 3 information, because remember, we're talking about an SEC rule here in the United States that's proposed, but a lot of this reporting is already mandated and much further down the road in the EU. So a lot of our clients that serve EU related customers are already, responding to these requests. So this sets the stage for you. There's obviously a lot more information here, but I just wanted to get some common definitions, and we can go forward.
Yeah, so this is the proposed timeline, which, as you just said, is probably changing, but go ahead and talk about it.
Yeah, that's right. And it just gives you a sense of what was embedded in the SEC's disclosures there. We do think it's going to shift a little bit, but you can see how rapid it was. Even if the rule was finalized in October, not much time to react. So that even if it shifted some, and even if some of these elements of the rule are delayed or changed, the real message here is to understand this now, understand what it is, and make sure that you have a plan for how you're going to meet these requirements, because it could take quite a bit of time with pulling people together in your organization and perhaps reaching out again to utilities providers or others to set up processes for collecting this information. Okay, we can go forward.
Okay. So one thing about the challenges that you were mentioning, are there others that companies should be aware of? Some examples of some topics or whatever that companies should be focused on?
Yeah, so as I said at the outset, the regulatory environment is a key element. As you're assessing your ESG strategy and your plan going forward, we think about who your key stakeholders are, and the regulators are an important one, because obviously we want to stay compliant with regulations, and we want to understand the regulations that we're subject to directly, and then the ones that our customers are subject to, because they may ask us for information to help them comply. So I've listed here some of the ones that we see commonly as we work with global companies. Just at a high level, we talked about greenhouse gas emissions. Climate is right at the top of everyone's focus now. So understanding your emissions and starting to get those calculations together. Conflict minerals, mineral compliance, I would say product compliance. Content of products has been an increasing focus over the last decade or so. The conflict minerals rule came out in 2012. We've been working on that issue with manufacturers for a decade now, and we see more and more focus on what is in the products that we buy, where does it come from, and then how does it intersect with the next topic, which is forced labor issues. So a lot of the sourcing that happens in the world, a lot of the mining and other product requirements come from geographies that have labor issues, in some cases child slavery and a lot of other problems. So these things have been tied together. You see a number of countries around the world establishing new labor requirements for due diligence in your supply chain, filing disclosures on your website, and in some cases where executives have to sign off on those every year to indicate how you're assessing and mitigating the risks in your supply chain. The UFLPA, the Uyghur Forced Labor Act, is a new one that popped up in June, and it targets a specific region, the Xinjiang region in China, where they have Uyghur forced labor camps. And Biden signed that into law in June, and that's causing a lot of concern now because border protection is Customs and Border Protection is grabbing product and holding it at ports, and there's a burden on the importer to prove that none of the, in particular, the cotton or the polystyrene or other things that are in these products originate from the Xinjiang region in China. So that's a big concern. And then I mentioned others. I would just point out the acronyms and apologize for all the acronyms. There's a lot in ESG, but the non-financial reporting directive in EU, which is now called the CSRD, that's really compelled sustainability reporting in Europe. So they're very far ahead in some of these elements that we're talking about. So all the non-financial risks around climate, supply chain, labor issues, et cetera, are compelled reporting in the EU. So that's why if you have if you work at an organization subject directly, or if you have customers who are there, you're seeing all these requests. So the regulatory environment, the key topic here, the key issue is have a plan and a process for staying on top of these issues, coordinating with the people in your organization who are managing the regulations, because they will intersect with your overall ESG goals for reporting.
Yeah, so these are things with the SEC, it's CorpFin and Office of the Chief Accountant, but the Division of Enforcement has been kind of busy with some ESG issues, and there have been some enforcement actions. So why don't you give us an overview of what some of those have been?
Yeah, and as I said toward the outset, the SEC has been very active over the last 6 months or so, and I think caught a lot of people by surprise. And if you look at those enforcement actions on the SEC website, you can see as they're adding to them. And a couple of things to note. One, they're across all industries. And I think a lot of them are more straightforward, traditional investor fraud. So disclosures around that mislead investors around the financial performance or the overall goals of an organization. But they're tying them to ESG, and that's really the key here. And one in particular caught my attention, the Vale mining collapse. That happened in 2016. And so the litigation around that was continuing, and the enforcement action was just announced. But at that press conference in 2022, the SEC explicitly pointed to Vale Mining's website that they said had false ESG disclosures around safety. So they're taking a lot of opportunity to drive home this point that you're misleading investors and you're misleading them around ESG related topics. And that aligns with the SEC's the proclamation that ESG information now rises to the level of an investor disclosure.
Okay, we're going to move on. Joey, let's move on to the reporting component of ESG. I know there's several reporting frameworks and standards that Chris had mentioned. What's the current ESG reporting and disclosure landscape look like in the US?
Yeah, happy to go over what the current landscape looks like. And thanks, Chris, for that background on the SEC proposal, and as well as some of the terminologies being used in greenhouse gas emissions. I hope that background provided some of the audience that maybe is not familiar with the SEC rule some insights into its existence and its in the fact that it's big. And so this is really an important thing that's being addressed in our capital markets right now at the regulatory environment. And it makes sense that regulation is coming into play after you see some of this data, because what this data shows is that there's already a voluntary and a contractual movement in this space. So it would make sense naturally that regulation would follow. So the CAQ embarked on a mission to look at all of the 2020 sustainability reports, those ESG reports that you find on company websites, or maybe even some of your companies produce. We wanted to really understand what was in them. And so we found that there was 3 common frameworks being referenced and used to derive the contents of the reports: the SASB, the GRI, and the TCFD, so the Sustainable Accounting Standards Board, which is really now the ISSB, the GRI, the Global Reporting Initiative, and the Task Force on Climate-Related Financial Disclosures. There's a concept of integrated reporting framework as well, more in Europe, slowly making its way into some US reporting. The one important note is that there isn't just one standard or framework that companies are using. Our data shows that more than 230 companies are looking to 3 or 4 more standards or frameworks, plus using their own sort of methodologies and just their own business information to derive the contents of the report. So there's a lot of standards and frameworks being referred to, and a lot of them being used to derive the contents of these reports. We wanted, the Center for Audit Quality, we're keenly focused on assurance, regulatory environment over insurance, the how to operationalize assurance. And so when assurance is happening, we want to know what's going on. And we actually found that in 2020, 282 companies had some form of assurance over their over some sustainable information. So this could be your greenhouse gas emissions, it could be your water. It could be a number of sustainable items that you disclose: your human capital, diversity and inclusion, your waste, social commitments, the money that you've said that you've donated. And so hundreds of companies are already getting assurance over some of this information. And it's actually interesting. We don't have all of the data here. We don't have the time to present it, but I encourage you to look at our CAQ resources to take a deeper dive live on our website. But it was encouraging to see that scope 1, that scope 2, that scope 3, you might think that this is sort of impossible or not being done, but actually hundreds of companies are in fact reporting their scope 3 emissions and getting assurance over some of those scope 3 emissions. So the ball is really moving here. When that assurance is taking place, though, it's largely non-CPA firms doing that work. There are CPA firms, the big 8 accounting firms and more public company accounting firms that do this work. Our analysis showed that more than 40 of the companies were using, the accounting firms, and then more than 240 were using non-accounting firms back in 2020. Let's go ahead and jump to the next slide.
Yeah, so you also did an analysis of the disclosures of climate-related info in 10Ks. So why don't you give us an overview of what this is? Oh, I'm sorry, this is...
Actually, let's go back one slide. We're still on just the level of verification that we found within those sustainability reports. So when assurance is taking place, like what does that mean, right? There's higher levels of assurance, that would be reasonable assurance, and then there's maybe some lower level of assurance that'd be called limited assurance. And the SEC rule as proposed would require limited assurance for a period of time over your greenhouse gas emissions, and then in the future move to reasonable assurance, a higher level of assurance of that information. So we wanted to know, well, what was the market doing in reality? And what we found was that limited assurance was the predominant level of assurance being provided over the sustainability information. There were several instances where reasonable assurance was being referenced. When you're a CPA firm, that term limited and reasonable, those really have defined definitions and procedures and protocols around, if you will. And then when you're not a CPA firm, that terminology could be different, or the definitions might even be different. So we do see those non-firms using similar terminology, but we don't know if that means the same thing. And then we also see non-firms using different terminology to describe their level of assurance. But by and large, we're seeing limited assurance being performed over sustainability related information. And Margot, yeah, we also, this data was just 2020 for sustainability, standalone sustainability reports. And we also did look at the S&P 500 10K, so 500 company annual reports for the 2021 period to look more specifically for climate disclosures. So we can move into those slides.
Here we go. So how many companies are including this in their 10Ks, and what is it that they're including and where?
Yep. So again, this data here is looking strictly at the 10K, right? Not information disclosed outside of that 10K. And even more specifically, we were looking at climate rather than the broader sustainability information, water, waste, diversity, inclusion, et cetera. So this information here is just 10K focused and really kind of climate greenhouse gas focused. And what we found was that most companies, over 450, were including climate related information in their 10K. It could have been a risk note, it could have been a very clear business note, an MD&A note, it could be a financial note. So 450 companies were making some sort of climate related disclosure. And when they were making that disclosure, most of the time it was in the risk factors, 437. And companies have climate related disclosures in different parts of the 10K and multiple parts. So the next item would be your item 1 business. And let's go back one slide, please. And then your next part would be item 7, MD&A. And then there was climate specific information in item 8, financial statements. So the 10K is structured with 15 items. These are sort of the 4 predominant items where you would expect to find climate related. There are other items like executive compensation that had minimal references. So they're not the only items within the 10K where climate information is being disclosed, but it's the most common, the common areas as of 2021. Also, what's really cool about this data is the time that we got it, right? 2021 10Ks came out in February, March, April of 2022. And that SEC rule got released at the end of March. So I like to think of this data as just being totally uninfluenced by regulation. It's entirely voluntary, contractually, what companies were doing before there was any SEC proposal, which I think is going to spark a greater acceleration of these disclosures. So I think the timing of this data is awesome. Okay, let's jump to the next slide. And I apologize for all of the words on here, but what were those companies disclosing, right? In their item 1 business, they were oftentimes talking about the megawatts of energy that they were using, their amounts of greenhouse or renewable energy. They were referencing at times their scope 1, 2, and 3 emissions. They're providing dates for their net zero or carbon neutral commitments. They were referencing to the sustainability report that they might have had on their website. In some instances, they were providing direct costs for research and development or the compliance costs for climate related issues, capital expenses to innovate or to upgrade systems to be more carbon friendly. And then in the risk that was sort of in their item 1 business, and then often those were replicated in the MD&A note. So the MD&A note was in many cases a replication of what was in the item 1 business note or slightly expanded on it. In terms of the risk factors that sort of stood out, there was a lot of state specific regulatory risk factors. There was the potential for laws and regulation and litigation for not achieving certain carbon rules. There was reference to potential losing of customers due to their changing of preferences towards cleaner, more environmentally sustainable products and services. So there were a number of factors. These aren't all of them. Each company has sort of different specific risks, from supply chain issues to their human capital. But these are some of the samples of like specifically what companies were disclosing in their 10K.
So I want to mention 2 things. One, these slides are available through the ECI, and also these data are on the CAQ website. So you want to talk about item 8 now, Joey?
Definitely. So this is the item 8. The reason why this is kind of important is it's the financial statements, and it's what's audited. And you might expect to kind of see most costs there, but you actually didn't. You saw some more costs in item 1 business, and maybe that's because they weren't material. But the point being, in item 8, most of the time that specific climate was mentioned was in a commitments and contingency footnote. And oftentimes that couldn't be calculated. So an environmental contingency, right? There were some other disclosures of like green bonds. A lot of companies have entered into green bonds, right? You produce less carbon, you get a better interest rate on the loan, that type of thing. And so those terms are being disclosed. And that's some big new business. You know, think about it from investment banking and from financing standpoint. It's sort of a future lending tool. And then also critical audit matters. We even observed a critical audit matter, which is something that is complex, requires communication to the audit committee, requires judgment. And so we had a critical audit matter that disclosed climate change this year in 10Ks.
So you mentioned that these are part of the financial statements. Do companies tie climate-related disclosures to the figures in their financials?
So for this slide, you know, 40 companies provide climate-related figures, right? Explicit R&D, CapEx, compliance. However, those weren't all in item 8 financial statements, and not necessarily tied to any line item, if you will. And so I think that companies are making monetary climate-related disclosures. They do this in different areas, and around 40 companies did provide what I would say, you know, explicit, clear monetary figures as it relates to climate information.
Okay, so Chris gave us an overview of GHG disclosures, and you were speaking about that too, scope 1, scope 2, scope 3. What did your analysis show with respect to the number of companies that are disclosing GHG emissions?
So I think that this slide shows those companies that disclosed explicitly scope 1, 2, and 3, either their emissions, their objectives, or the status of that. So that's companies that are 104 companies are either giving you their actual emissions or telling you what their plans are for the next year, or telling you that they're in the process of making plans. But this slide doesn't show all of the companies talking about greenhouse gas emissions. There's another 100 companies that aren't talking about scope 1, 2, or 3 specifically, but are disclosing some level of greenhouse gas emissions. So a couple hundred, more around 250 companies, call it half as a fair number, are talking about their greenhouse gas emissions. And again, that could be direct reference to the scope emissions, scope 1, 2, or 3, could be in the context of their net zero or carbon neutral commitments. The 104 in 2021 10Ks mentioned or disclose their scope 1, 2, or 3 emission status and / or objectives, right? That's a very important statement, given the timing.
So you mentioned net zero commitments, and you did some analysis on the S&P 500. So how many of those companies have disclosed their net zero plans?
Yeah, so 120 in the 10K. We know that outside of the 10K, there was 211 in those sustainability reports that we looked at in 2020. So we know that there was more than 120 outside of the 10K before 2021. But in 2021, in the 10K, we had 120 companies bringing their net zero or carbon neutral into the 10K, disclosing that in the 10K, which is significant. This is the go-to document. The 10K is the go-to document if you're gonna want to know anything about a company, right? It's any fundamental analysis, any investor is going to go refer to that 10K. So the information brought into that, it has signed off by the CEO and chief officers. So we want to know what's being brought into it, and 120 companies brought in their commitments there. And it's no surprise that most of the companies put the commitment date at 2050. That was the Paris Agreement, I believe. But these were just the breakdown of dates for when companies aim to achieve them. So 2050 was the largest year, followed by 2040, 2020. I think it's important to note that not all carbon neutral and net zero commitments are equal. right? A company could say that they want to be carbon neutral over scopes 1 and 2. Another could say we want to be net zero over 1, 2, and 3. I think it would probably take a long conversation for us to break down the big differences in that. But when they make the commitments, these are sort of the years that they're committing to, and will save sort of the differences for maybe another session.
Yeah. Okay. So we can stop sharing now. We're done with our slides. So Chris, we have an audience full of compliance and ethics folks. With all this ESG data that companies are including in their sustainability reports, their websites, SEC filings, whatever, there is a potential for misreporting, either intentional or because of errors in data gathering, et cetera. So I think it's going to be important for the compliance teams to exercise some skepticism and ask hard questions, but wanted you to give us an overview of what are some of the ESG related misreporting risks the company should be aware of.
Yeah, I agree with you. Again, this is set against the backdrop of moving from voluntary to mandatory with a lot of intensity and a lot of focus on these ESG related, and let's just say greenhouse gas emissions numbers as one example. And you heard from Joey how these numbers are distributed across the largest companies. Some are reporting, some aren't, some are doing it with narratives, and some are including quantitative measures. And it varies a lot. And now we're moving into an environment where the expectations will be that everybody will do this in a regimented and rigorous way. So everybody's starting at a different point. Some are starting from scratch, some are pretty mature. I think regardless of where you are, though, you face these concerns about data integrity and financial reporting integrity. So if you're starting from scratch, who's responsible for doing this within your organization? We want to make sure that you have all the right people around the table. The first step may be to form some, we call it a cross-functional team or an ESG committee, to make sure that you have the right visibility to what it is that you're going to be reporting. You have to have people who understand the underlying frameworks and the emissions data, but you need other people in the organization that maybe understand where that data is coming from. Still others in maybe an IT that can help you source it, maybe others in internal audit that can help you with the controls and setting up the processes for it. So you want to replicate what you've done around financial reporting with these new measures. So I think everybody understands generally the structure of financial reporting. How do you now transport ESG into that more rigorous structure? And again, depending upon how coordinated you've been in the past, they may be very, very separate people, and you have to make a lot of introductions now. So you're going to be meeting your colleagues, making sure you bring them together and you have all the right people around the table to understand what it is we're going to be reporting on and why, and then how we're going to move that forward. So if you're starting from scratch, there's a risk that you're going to miss something, misinterpret something, have some errors, or have some omissions, try to rush for something in there. And there's always the typical concerns around data integrity. If you're in a more mature environment, you could have some other types of pressures where you've reported some things in a sustainability report, and those are out there as what you feel is your starting point. But now as you take those and you move them into this new world of much more rigor and focus, with now the financial reporting people look at it, asking you questions, maybe they're looking at the controls around it that hadn't yet been established. There's some pressure to see, well, are we going to maintain those numbers? Are we going to revise them? Are we going to reboot our process and move towards financial reporting? So as you're developing your understanding and as you're working together, there's always a challenge with making sure you have, again, all the right people, all the right information. It takes a team to get this done. And remember that we're working against an evolving landscape. The rule is proposed. It's not final yet. The standards and frameworks that we use to comply with the rule were voluntary in nature, and we're seeing some of those coalesce domestically and globally. So everything around us is sort of shifting as we're moving towards compliance. And so with that backdrop, that I think it's even more important to get everybody together, risk and compliance and sustainability, legal, IT, accounting, and internal audit, get everybody together and make sure that you have a structure for deriving these new numbers, understanding where they come from, validating them, and making sure that they're ready. At some point in the future, your CFO is going to be looking at this information and going to have a lot of questions. And you want to be able to make sure that you can say, yeah, when we started this process a year ago, we built out, everything that you need to make sure that it's rigorous, that it's verifiable. So have internal audit take a look at it, You also need to prepare, like Joey was talking about, for external audit. There's limited and then reasonable assurance. We're going to see an uptick. We're already seeing, as an accounting firm, a lot of clients asking about pre-assessment, gap assessment, audit readiness. What are you going to expect? So again, there's going to be a lot more people looking at this. You need to build in the time and the expertise.
Yeah, yeah, and the CFOs are pretty used to, at this point now, very rigorous controls over financial reporting, so they will probably apply that same framework or that same rigor to the other data for ESG. Joey, having been a former auditor and working at the CAQ, do any of these risks sort of stand out for you in terms of how the perspective of the auditor?
So I guess there's, we have the human capital, these carbon neutral net zero commitments. I think from a human capital perspective, the SEC rule currently requires companies to disclose in their 10K the number of companies, the number of employees that you have in the company, and whatever else you'd like to disclose about your workforce, right? That's sort of how the rule is written now, and it was written like that a couple of years ago. So we saw disclosures around diversity of the workforce, employee compensation and benefits, employee engagement, health, safety, and wellness. Those were the types of things that companies voluntarily disclosed the past couple of years around their human capital disclosures. The voluntary nature of the way the rule is written makes some inherent consistency and comparability challenges. You combine that with every company's got unique workforce challenges and industry specific challenges. The human capital disclosure, it's not standardized, right? Not every company discloses like each of these items in the same way. And so I'm referring to that human capital item 1 business, right? In your 10K, there's a rule that says you have to disclose something about your workforce called human capital disclosure, right? So I'm specifically referring to that rule. The SEC is likely going to make some changes to that. So just from a general risk perspective, being on top of what that future rule might be. Is it going to come in the next month or two or early next year? Doesn't matter to me. Just kind of being aware of that evolving rule. In terms of sort of the net zero and carbon commitments, look, the SEC said in their proposed rule that if a company has climate related targets or goals, right? So if they made a commitment to be net zero by 2040, they would need to disclose the scope of those activities, the time horizon, interim targets, how they plan to achieve those targets, and then provide updates on those. So making sure that when these kind of commitments are made and disclosed, that there's a real plan behind them, like a real plan behind them. And I think that,
go ahead.
And I think at the heart of all of that is that this is important to compliance professionals and ethical professionals, that these statements that are made, they're not made to deceive, and that they're accurate, right? Like compliance departments, auditors, everyone should be kind of keenly aware that things that are said should be verified for accuracy and intention.
And I think, as you were saying, if you've made 2040, 2050 net zero commitments, you can't wait until 2 years before that. And so some of the things that you have to do to actually meet those commitments should have financial implications. So Chris, I wanted to ask you about how companies should manage that transition from ESG reporting sort of being non-financial to all of a sudden it having a financial impact on the company.
Yeah, it's a significant transition, and as we talked about, there's so much more rigor around financial reporting that exists. So you need to take advantage of it. You understand the process, and now we're pulling in a lot of new information, and it's not just greenhouse gas emissions. As Joey said, it could be diversity, equity, and inclusion issues, or the workforce issues, and other governance issues. So the first step is we need to understand again what it is that we have to do. We have to do a what we call a materiality assessment or stakeholder engagement. We need to understand all the things we're going to be reporting on. It may just be, for example, that you're really driven by the SEC proposed rule, and that's what you need to touch on for climate. That's fine, but there's a lot in that rule, as we talked about, and it takes a lot of people in planning to make sure that you're deriving the right information and that you're able to get to where you need to be by the right time frame. And as we talked about, we don't necessarily know what that time frame is right now, as we're working through comments and as we're working through midterm elections and all the things that are happening. So with that in mind, the best practice is really a couple of things. One is currently educate your board and make sure your management understands what the goals are of your ESG reporting overall. And remember that we want to talk about what's happening in the financial statements, what we're going to have to put in there. But like we talked about, the SEC cares about all of this. So if you have a plan, if you have a sustainability report, you need to understand what's in there, what topics are going to be there, what frameworks you're using. Is there good data? Is it verifiable, comparable, and auditable? Would it stand up to the rigor of anything from a ratings agency to an activist investor to someone else benchmarking you, customers pressing you on it, or even a regulator taking a look at it? So it really does add a lot of pressure to these disclosures, and you need to go back and I would say have a pretty good reset with your sustainability team and with your management team to understand what's really the goal of the sustainability reporting and what are the implications of what we're doing. Establishing a baseline around some of these topics and measurements, great. What's our progress going to be? What does this look like year over year? We don't just lay down numbers and then stop there. And if we're making commitments, we have obligations to explain how we're going to get to those commitments. There are a number of cautionary tales out in the world that you can find now with companies who've been a little maybe overly zealous with some of the things that they've talked about and tried to do, and run into some real world challenges where we've said, we promise our supply chain is sustainable, but then we realized, well, we really can't guarantee that because of all the layers of the supply chain and the challenges of making others do what we'd like them to do. Or we have these net zero commitments, but we have to make sure we understand exactly how we're going to get there through a combination of our own processes and carbon offsets and other things. So this whole environment now is really amplified in terms of intensity and importance. But the good news is there's a lot of things that companies have already been doing around ESG. They're already there. They're in your HR group. They're in your governance structure. They're with your environmental health and safety team. So you need to bring them together. And you have a lot of examples of good reporting, things you've already been doing from a regulatory perspective that have validated numbers that you can rely on. So take a good inventory, bring together your team, and take a good inventory of all the things that you're already doing. What you might find is that the climate rule and some of these other new things really require a lot of your attention, but the other issues are in pretty good shape. We just haven't brought them all together under the umbrella of ESG reporting yet. We've thought about them in siloed fashion. EHS taking care of, our waste management over here, HR taking care of our people, and our board taking care of governance. Now those things are pulled together. So it's all there. It just takes you some time to get it together and then report it in a way that's more rigorous.
Yeah, so it sounds like there's a good opportunity, if they haven't grabbed it already, for the compliance team to play a major role in pulling all these people together.
Huge role here. The compliance folks who are broadly defined here as risk and compliance folks, legal, internal audit, and everybody else who I view as providing lines of defense for the organization. So critical role to step in here because they're the ones who understand how controls are supposed to work. You have the experience with making things rigorous and ready for external reporting. And that's really what we're doing is taking this ESG information and making sure that it's that strong. So yeah, compliance plays a critical role here.
Yeah. Joey, I'm going to ask you, how can getting assurance around these things increase the reliability of ESG reporting and disclosures? And how can auditors, the external auditor, collaborate with the compliance function and other business functions during this process?
Sorry, I lost my mute button there. So I think that the same way that assurance provides trust and reliability over financial statements is the same sort of way that it's going to provide trust and assurance over the sustainability information, right? There is a public interest role that auditors play, and a part of that is making sure that there's accurate, decision useful information for the market. That's at the core of what we do. And I think some of the basic, blocking and tackling work that auditors inherently do day in and day out is a part of how they prepare for ESG misreporting risks and also enhance the reliability of it. From the auditors are at the moment, firms are engaged in a lot of different activities, and I recommend for the audience to engage your firm. You might start with your financial statement firm on this. Engage professionals, because they're really setting up and doing a lot of great work, from assessing the SEC rules. The firms are kind of assessing the rules and figuring out what that's going to mean for the clients. The firms are considering their independence and taking all the precautionary, necessary steps that a public company accounting firm would need to take to enter assurance engagements over ESG related information. Many firms have disclosed investing in staff, new staff training, resources, new technology. So all of that, I think, helps enhance the reliability of the information, as well as helps sort of mitigate, ESG related misreporting this. I do want to just kind of make a quick note, though, with respect to the auditor's responsibility for information in a document that contains the audited financial statements, that does not extend beyond the financial information identified in the auditor's report. Right? The auditor has no obligation to perform any procedures to corroborate other ESG information. However, PCAOB auditing standards do require that the auditor read other information and documents that contain the audited financial statements. That would include ESG information, and then consider whether that information or the manner of its presentation is materially inconsistent with information appearing in the financial statements. So, for example, if a company discloses ESG related goals and progress in achieving them in the MD&A of their 10K, the financial statement auditor would really only be required to read the presented information for consistency with the financial statements or material misstatements of the fact. The auditor wouldn't be required to perform auditor review procedures directly on that information. And a material misstatement of fact is a very high threshold. And given the nature of ESG information, it may be highly unlikely the auditor would be aware of a misstatement of fact, given such information is outside of the scope of the audit of financial statements or of the internal controls on financial reporting. And so I just want to be clear about what the auditor is responsible for when it's auditing the financial statements. There could be things that are disclosed elsewhere, and an auditor is signing an audit opinion on that information in item 8, the financial statements, not that information in necessarily item 1. And so I just want the audience to be clear of what the auditor's role is.
We only have about 10 minutes left, and we do have some audience questions, so I'm going to jump to those. So Chris, this is probably more to you, but with respect to procedures that govern the involvement of finance, audit committees, and board of directors, any thoughts on common challenges across industries or for certain industries in terms of trying to coordinate?
Yeah, I think a couple of things. One is we're seeing a significant uptick in the demand for board-related training on ESG, as I referenced in earlier, and you heard also Joey talk about TCFD. That's the framework for the SEC rule, and that explicitly requires a narrative around governance and how the board manages climate risk. And I think that's causing a lot of people to take a look and make sure that they're prepared and that they understand exactly what the board's doing. The board has a baseline of education, and using this time now that we have to make sure that the board understands it can govern properly, set the right tone. The second thing is that we're talking about getting everybody together across the organization. And again, you have a finance organization that's very focused on financial reporting and accounting structure. All that's usually very well organized. And then separately, you have sustainability or ESG teams. And I don't know if they've met. I don't know if they're talking to each other. It varies. Again, some companies are very mature in their overall governance structure, starting from the top down. They have ESG committees that drives the activity of management, which drives the specific activities of the cross-functional teams. That's what you should strive for. Everybody has different resources, but the important thing is, first and foremost, to get everybody together, understand who you have and what you need to do and what the time frame is, and then assess your gaps and where you're going to need help. And then the other thing I'd point out is there are different roles that consultants play around these issues. There are people who help management as broad-based consulting to help them determine the pathway forward, derive the information, plan for reporting. There are people who help internal audit and supplement them as subject matter experts. And then there are, of course, external auditors. And you want to keep all of that in mind as you move forward, because you might start now asking questions of everybody that you do business with. And you want to ask your external auditors what they expect, but remember that they won't be able to do that underlying work for you. They play a specific role. Your internal audit team is going to play a role, and you may need additional help actually doing the underlying work. So be careful of what we call the lanes of service, so you don't create any actual or perceived independence conflicts a year from now, as you're getting closer to reporting. So just some of the things that we see, and that applies across all industries.
So here's an interesting question that came in that probably will impact many companies that are trying to even report their scope 1 emissions or their scope 2 use is, what about with hybrid and remote working? How, there was a time when everybody was in the office at the same time, so your utility costs were your utility costs. What happens with a company in terms of having a hybrid work environment?
Yeah, it's a great question, and the concepts of that would fit into a scope 2 to scope 3 discussion around employee commuting, and also with your business travel, same concept. So depending upon, again, more mature companies are already on top of that and have made, I think a lot of those are proxy estimates for what that might entail, and then understanding what the shift is over time based on new working arrangements, other transportation benefits, and other things that the company's doing with their programs. But that is something, it's a great way to think about it, because now you're starting to conceptualize what are the opportunities and the challenges with fully mapping out your emissions as an organization. As a professional services organization, Crowe is mapping its greenhouse gas emissions as well. We're not exempt, we're not public, and we don't manufacture anything, but we're not exempt from those obligations either. And we're tracking exactly those types of things. So understanding what are our systems for tracing business travel and assigning an emissions value and all the things that come along with it. So it's a great question, and it's something that will evolve. We'll see more or less of it depending on what the SEC rule finally requires, I think.
Yeah, and if I could just add on to that, Margot. I had this conversation with a friend of mine who's a vice president of a biopharmaceutical company. And I said, well, let's take a look at what the SASB materiality map says, right? And that was our starting place. And greenhouse gas emissions weren't a material factor. And I kind of said, don't worry about it, right? And I'm not telling him not to worry about it. But what I want to make is that when it comes to ESG reporting, it's not just a report all information for every reason. It's to report what is material to your business, right? What are the non-financial impacts that may hurt or help your business? And it might not have anything to do with emissions because you only have 5 employees and they work from home, and that's very low. And instead, there's 14 other things that you should be worried about. So I guess the point that I want to make is if you're truly just starting, go to the SASB materiality map, Google SASB materiality map, drill down into your industry, and it'll tell you about, there's 5 or 6 components, and it'll tell you what's material within each of them. And you may very well find out that your employees sitting at home aren't the material things you should be worrying about right now. Maybe you should be, but just want to make that point.
We have another question that came in for your thoughts on the lack of standardization across, the TCFD, the GRI, et cetera. And there is the new ISSB, the International Sustainability Standards Board. So Chris, Joey, sort of what's your hope for what that will achieve in the next coming years?
Alignment would be great. I do think that we have now a sense that SASB and GRI are the most commonplace reporting standards, again, for ESG related or sustainability reporting. Those are really the ones that companies domestically are using, and they don't contradict each other. It's just a matter of figuring out exactly how you're going to work through it with your materiality assessment and figure out what you're going to report on. TCFD, I think, is fairly prescriptive, and have to add in the GHG protocol. Again, sorry for all these acronyms, but you have to put those together in order to align with what it appears the SEC rule is going to be. So you do have to have an understanding of those. But in my view, TCFD and GHG work towards the SEC rule, and you need to understand those very quickly. And then the others, as SASB and GRI, are depending upon what you want to do from the remaining sustainability reporting. Globally, we do see some alignment. But I think that still has a little ways to go.
Yeah, and I'll let Chris's answer stand for the sort of corporate reporting standards, GRI, SASB, and I think just an important point on standards is I'm proud of what the AICPA is accomplishing from the attestation standards over this type of information, and giving assurance providers the right sets of guidance and tools to be confident that they could go in and conduct these engagements. So there's a lot going on from the standard center stand.
Yeah. In our last minute or two, key takeaways. Joey, I'll start with you. What would you like this audience to remember, if nothing else?
Yeah, why is the accountant getting involved in this? So there's been a Gallup poll that it comes out every year on the most trusted professions. The accountant isn't included in it every year. It's been included about 4 times since 2005. Nurses, medical doctors, those are included every year, lawyers, and a few others. But whenever the accountant is included, it's the #1 business professional rated the highest for honesty and ethical standards, right? And we basically, this accountants have a lot of trust in public, and you guys being compliance and ethical profession. I think it's important to know that it's natural for the accountant now to kind of move into this space, given the role that we play in financial reporting, given the role that we play in decision useful information. And I think it's important that accountants leverage that trust in society to help say this is a space that we belong, and this is a space that we can provide help. So I hope you guys check out the Gallup polls. Last time the accountant was included was 2018. It's a public poll from a variety of different people, and the accountant consistently ranks as the #1 trusted business profession for honesty and ethical standards.
And Chris?
Yeah, I think these are complicated subjects. They're evolving. It takes more than just a couple of people at an organization to properly tackle this and make sure that you're on the right pathway forward. And that clearly includes ethics and compliance and risk management, legal, and all the key folks that we think can help form the bridge between sustainability and financial reporting. So just keep that in mind. A lot to learn. We're all working on it, but so don't feel overwhelmed by it. It's evolving quickly. But I think it's here to stay, and certainly something that we're all going to be working on for quite a while.
Great. So thank you, Chris and Joey. Thank you to the audience for attending today, and thank you to the ECI for sponsoring this session.
Thank you.
Thank you.